Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest report from T. Rowe Price OHA Flexible Credit Income Fund, and let me tell you, it's packed with more financial acrobatics than a circus. Seriously, this fund is all about navigating the wild world of credit, and their latest report gives us a peek under the hood. What exactly are they investing in, how are they performing, and what does it all mean for potential investors? Stick around as we decode this one, and hey, if you're new here and love getting straight insights from complex financial documents, hit that subscribe button. Also, joining our Discord community is a great way to keep the conversation going, so check the description. Let's get straight to it. This fund, T. Rowe Price OHA Flexible Credit Income Fund, is basically playing in the deep end of credit investments. Their main goal is to generate income. They aim to do this by investing in a broad range of credit instruments and securities, and they can really shift their strategy to chase the best opportunities. As of June 30th of this year, 2025, the fund had a net asset value of $157 million. That's the total value of all its investments after subtracting its debts. Think of it as the fund's reported worth. Now for the performance numbers. Despite a pretty choppy market, the fund saw a return of 4.119% just in the first half of the year, and since it started, it's been averaging a solid 9.07% annually. That's pretty good, especially when markets are all over the place. The report says this success comes from their flexible approach, picking good credit deals and jumping on chances when markets are a bit chaotic. And how about income distributions? They managed to keep their distribution rate steady, ending the first half of 2025 at an annualized rate of 9.62%. That means they're consistently paying out income to their investors. Geographically, they are really focused on North America with about 97% of their investments there and only a small chunk in Europe. When we look at the industries they are invested in, high-tech is a big one, followed by business services, finance, healthcare, which also includes education and childcare, and then consumer services. Let's peek at some of their top 10 holdings. We see names like the Polaris Newco LLC term loan at 6.1% of the portfolio. Then there's Orion Advisor Solutions Inc. term loan at 3.2%. These are basically loans the fund has made to these companies. Now let's get into the nuts and bolts of their investments. Corporate loans make up a massive 83-69% of their total investments. That's the core of what they do. Within that, first lien debt accounts for almost 60%. This is typically the safest kind of debt, meaning if a company goes belly up, these lenders get paid back first. Looking at some specific first lien debt, we see Wheels Bidco Inc. with a 550% interest rate. Then there's Packaging Coordinators Midco Inc. term loan, making up 3.1% of the portfolio. In the high-tech sector, which is almost 8% of their first lien debt, we see companies like Banyan Software Holdings LLC, and also Finastra USA Inc. Moving on to second lien debt, that's about 24.62% of their corporate loans. This debt is a bit riskier than first lien because these lenders get paid back after the first lien lenders. In the high-tech sector of their second lien debt, they've got Polaris Newco LLC taking up a significant portion, about 13.43% of the second lien debt. They also have a small slice, 1.85% in asset-backed securities, which are backed by pools of assets like loans or mortgages. Bonds and notes are another piece of the puzzle, making up just over 10%. Within those bonds, oil and gas is a notable industry at 4.34%. We're seeing Ferrellgas LP bonds here. They also have a small stake in common stocks, about 1.66%. These are ownership stakes in companies. Preferred equity is another 4.62%. This is a type of stock that's a mix between common stock and debt, usually with a fixed dividend. Interestingly, their total investments are listed at 101.88%. This often happens due to how things like derivatives or other complex financial instruments can amplify exposure. Let's look at the balance sheet. As of June 30, 2025, the fund had $160 million in investments at fair value. Their total assets were about $170 million. On the liability side, they had $1 million in debt. This leaves them with net assets of just over $157 million, and the net asset value per share was $24.70. Now let's check out the statement of operations for the first half of 2025. They earned about $7.3 million in interest income. Their total expenses before any support were around $1.8 million, but they got $1.26 million in expense support, which really helped bring down the overall cost. This left them with a net investment income of about $7.1 million. And that all ties back to that 4.119% total return based on net asset value we saw earlier. Digging a bit deeper into their debt, the fund uses a CIBC credit facility, which is essentially a revolving line of credit. The total committed amount is $75 million, but as of June 30th, they had only drawn down $1 million on it. This facility is arranged through a special purpose entity called TRP OHA FCI SPV Funding ILLC. The interest rate on this facility is tied to SOFR or other benchmark rates plus a spread, which in the case of US dollar borrowings is 2.10%. Now I want to highlight their commitments. They have a significant amount of unfunded commitments, meaning they've promised to lend more money to companies in the future. As of June 30th, these unfunded commitments for delayed draw term loans and revolving loans totaled about $10.7 million. This is important because it represents money that might be drawn down later. Let's look at the share activity. The fund issued over 2.1 million Class I shares during the first half of 2025, bringing in over $53 million. So what's the big picture here? T. Rowe Price OHA Flexible Credit Income Fund is actively managing a portfolio heavily weighted towards corporate loans with a focus on first lien debt, which is generally less risky. They've demonstrated solid returns and income generation even in a volatile market, and they're keeping a pretty tight rein on their debt, using their credit facility cautiously. However, those unfunded commitments are something to watch. They represent potential future capital deployment and could impact liquidity if many of these commitments are called at once. Their strategy appears to be focused on credit selection and capitalizing on market opportunities, which has paid off so far. They're also sticking to North American markets, which simplifies their risk exposure compared to a global portfolio. Overall, this fund seems to be executing its strategy effectively, aiming for income generation through a focused credit approach. But remember, investing in credit, especially below investment grade or in more complex structures, always carries risks. Make sure you do your own research and understand how this fits with your own financial goals and risk tolerance. Alright, that's our deep dive into the T. Rowe Price OHA Flexible Credit Income Fund report. What do you think about their investment strategy and performance? Let me know in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe for more content just like this. And don't forget to join our Discord community in the description for more financial insights and discussions. Thanks for watching, and I'll see you in the next one.